Hello and welcome to Super Insider, a podcast on all things investing, the economy, retirement, proudly brought to you by Australian Retirement Trust. If this is your first time listening, allow me to introduce myself. My name is Anne Fuchs and I'm the host of Super Insider. And today we are talking all things the economy and investment performance and what it means for your very precious retirement savings. And I have two wonderful gentlemen that I work with, love working with, Brian Parker, our chief economist, and Andrew Fisher, who is our General Manager of Total Portfolio Management and Resilience. Welcome, gents.
G'day, Anne.
G'day. Now, before we get into it, of course, listeners and viewers, this is general advice, general information only, and you'll need to make sure that it's right for you. Now, before we kick off, I just want you all to know that we're in a new studio. If you're watching, you'd be used to our old digs, but now we have some new digs. We're ratcheting it up a bit in Super Insider, and we're going to be having a big chat today about the economy, investing, as I said. And Brian, are you able to just take us through the key thematics around what the economic drivers were over the last 12 months?
Look, it was a great financial year for markets. The global economy kept growing. Inflation came down pretty much across the globe. And we managed to bring inflation down without doing serious economic damage pretty much anywhere. And that allowed interest rates to come down. So that, for most of the year, provided a really nice macro backdrop for share markets in particular. That's really kind of turbocharged investment returns over the year.
So are they Australian economic thematics or global economic
Very much
thematics?
global. So we saw most of the world's major central banks cutting interest rates over the course of the year. Inflation came down in most economies across the world, and the global economy kept growing. So that was a really good story. And the Australian story was very much consistent with that. And that was the sort of overriding trend, if you like. But then we had, obviously, tariffs thrown into the mix earlier this year, which caused a lot of volatility. But really, we saw Liberation Day announcements, and the more the president spoke, the further down share markets went. And so markets went into a panic. And then about a week or two later, Trump changed his mind and decided to put the whole thing on pause. And share markets have really been on a tear ever since. And so it's really has ended up being a very, very strong financial year, despite so many uncertainties out there.
What I'm hearing that the Australian economy, there's a bit of a Goldilocks vibe going on here. Is it just?
Yeah, look, I think with Australia, it's not brilliant. I mean, you look at the headline numbers, we're growing, but we're not growing at a spectacular rate.
Yes.
The labour market's still very solid, which is great. We still have, historically reasonably low unemployment rates. We're seeing growth in real wages after several years where living standards went backwards, but we're now starting to see real wages grow. Jobs are still growing. And so it's a reasonably good backdrop, even though the economy hasn't been growing at a terribly fast rate.
And I will do a little plug for the Treasurer's Economic Reform Roundtable to drive productivity that our chair at Australian Retirement Trust is attending. I'm talking about those big themes to drive more productivity in the economy, which is quite exciting.
Yeah, and productivity is very much a longer term issue, and there's no magic wand, there's no silver bullet. And it's really, really important because we all want to see real wages grow, but in order for wages growth to not feed higher inflation over the longer term, we need to see better productivity growth. And certainly productivity growth across the whole economy hasn't been all that flash in the last few years. And so, and there's nothing we can do to turn it around on a dime. It's got to be something which is going to have to be dealt with over a period of years, really.
Okay, structural change.
Absolutely.
Andrew Fisher.
Hello.
So Brian has explained those big macroeconomic trends. Our members would be watching the TV and maybe looking at their balance and thinking, how has this resulted in investment performance for me, my retirement savings? What have the numbers done? Tell me what the numbers have done.
So as Brian sort of pointed out, it was a really good year. Pretty much all our investments did reasonably well.
If you watch the TV, though, people probably wouldn't realise that.
You wouldn't think it, right?
No.
I think a lot of people are probably going to be surprised when they get their statements at the end of the year and realise just how well their superannuation has done. Our high growth option delivered 11.9% for the year, which is beyond our expectations.
Beautiful set of numbers.
Fantastic numbers. And after, I think this is now the third year in a row of over 10% returns, we now see that option as the number one performing option over 10 years in the super rating survey, and then 11.2% for our balanced option as well. So members that are closer to retirement are likely in the balanced option. They would have got 11.2% returns. Phenomenal outcomes. And if you look across sort of all the asset class returns, everything did reasonably well. Global equities did reasonably well. Unhedged global equities did better. Australian equities on a sort of after-tax basis did incredibly well. Actually, one of the best years we've had for a while there. Our local infrastructure investments were also particularly strong performers.
Okay, so over the years as Super Insider, we've spoken about the different asset classes and how we construct portfolios, but maybe if we can go into some of the specifics.
Yep.
What were some of the high points that have been driving that investment performance, Andrew?
So last year, we sort of touched on infrastructure did quite well. And within infrastructure, it was domestic more so than global. And areas like airports in particular did quite well. You might have picked up a newspaper, and if you picked up the AFR at any point over the last sort of year, you probably saw AirTrunk somewhere in that. And that was one of our most successful investments over the year as well. But then that's last year. If you go back over the past 5 years, one of the things that's sort of surprised me, but shouldn't really surprise me, I guess, is it's been a different story every year. So if you asked me these questions each of the last 5 years, I would have given you a very different answer as to what drove performance. And reflecting on that, I think that's one of those important lessons around diversification. We have a really diversified unlisted asset portfolio. And so in 2021, private equity was the best performing asset class in our portfolios. In the sort of period just after that, when inflation broke out, you had infrastructure and real estate doing really well. Now you've got airports doing really well and domestic infrastructure standing out. So it really has been a period over the last sort of 4 to 5 years where it's shown powerful diversification.
That obviously rings true from an investment principle point of view, but the velocity of change is something we all know in our personal life. Like, you know, the world is changing rapidly in terms of trends with technology and movement of humankind around the globe that is unprecedented. What are the stories underneath the hood of these drivers that Andrew's talking about? Like, why are airports so successful? Why is AirTrunk? What's the story behind it? The economic thematic?
Well, firstly, I think for the airports, it's pretty straightforward. We started travelling again. And people like to travel. That's the reality. And we've now seen passenger numbers return to fairly comfortably above pre-COVID levels. And so that's really turbocharged airport returns, particularly here in Australia. It's also boosted returns from our exposure to, say, London Heathrow, for example. But some of the other thematics that are playing out in the portfolio, which are quite interesting. Andrew's mentioned AirTrunk. So the rise of artificial intelligence and the demand for data storage space has really meant that data center capacity has been in big demand. And so we've been able to generate really amazing returns from having assets like AirTrunk. And that's been very much a unique story. Another thematic which is interesting is aged care. Now, in more recent years, parts of the property market have really struggled. So big commercial office towers, for example, both here in Australia and elsewhere, especially if you're not in absolutely prime locations, have tended to struggle a lot. But other parts of the property market in our portfolio that have been able to benefit from particular thematics have done really well. And one is aged care. Aged care is a really important thematic because we still have a serious shortage of quality aged care facilities here in Australia. And it's a similar theme in the United Kingdom, where we also have aged care facilities. And we think we can continue to grow that portfolio because the shortage is not going away. And so if we can actually help supply new facilities, partner with really good providers who actually provide the care. So we're not in the business of providing aged care. We are simply the landlord. But if we can actually fund these facilities and earn a commercial rate of return that's independent of what's happening in the stock market, that's a really good story for our members, but it's also a really clear benefit to the community as well.
So your point around retail is not dead and shopping, and certainly I can attest, as I know, Fisher, you can as well, that teenagers think parents have a money tree that's fed often with sea salt and all sorts of fertilizers that just keeps growing. There's a really cool shopping chain that we own in India.
Yeah, private equity is an interesting story because private equity allows you to access a whole range of opportunities that you might not get if you just limit yourself to what's happening in the stock market. Most of the economic activity produced globally is small and medium enterprises, and most of those are not really listed on stock markets. So if you want to access that economic activity, you really need to be in private equity. And so we partner with, carefully chosen private equity managers here in Australia and globally, and you can certainly access opportunities that actually are going to benefit from the development we're seeing in India. So there was a business called Vishal Megamart, which is basically a low to mid-market retail chain in India. And we invested in that business some years ago now. And obviously during COVID, it needed some TLC, as did every business. But since then, it's recovered very, very strongly. It's continuing to grow. It's benefiting from the ongoing growth in the Indian economy, rising living standards in India. And this has been a really, really good long-term story. Now, we managed to float a chunk of the equity in that company on the New Delhi and the Mumbai Stock Exchange late last year, have really generated very, very, very good returns. We're still holding on to a chunk of the business. We haven't exited completely because the team thinks there's still more juice to be squeezed out of the orange. So we're still there on the register, but we've certainly de-risked our position. In other words, the proceeds from the sale have more than covered our costs plus change. So it's pretty much pure profit from here. And that's the kind of opportunity that private equity does give you.
I think this is where being big is really helpful. So Art's one of the largest global asset owners.
You've read my mind.
Yeah. So being like that enables us to do this. Like you have to have a lot of irons in the fire is one way of thinking. But when we invested in AirTrunk, AI wasn't really a thing. We were investing in cloud computing. AI came along. This is the pace of change. That has happened really, really quickly. We've benefited from it, but you've got to have lots of these investments. That's where private equity is really helpful.
But how does it work being big? And I'm seeing little Artie, a little version of our big Artie sitting here joining us in the studio today. When Liberation Day happened, how does a big fund like ours respond in a moment like that where we've got to make sure the portfolio is resilient? And to protect members from that downside. Also realizing that superannuation is such a long-term investment. Tell me about it.
But first and foremost, like this, that comes back to planning and preparation. So for a large fund like ours, we can't be one of the people who are selling in the middle of everyone else selling. Like there's not enough liquidity in markets for that. In fact, when all of that was happening, we were already positioned and we're actually buying back equities at cheaper valuations. And so a lot of what we do and think about from a strategic point of view when we set up all of our sort of capabilities is using our scale to our advantage. And the best way you can do that is by being a provider of liquidity. So when everyone else is selling, you want to be buying. When everyone else is buying, you want to be selling.
It reminds me of a previous episode of Super Insider talking about how our investment performance is almost like a tennis game. It's not one big bold shot. It's just incremental, not losing a point, being really well planned, rehearsed. That's kind of what I'm hearing when you describe that.
Every penny counts. We're so focused on efficiency of implementation, how to get things done really cost effectively.
And I think all of our members can relate to that because that's true probably no matter what your size. So volatility is something that ultimately is good as an investor, to your point around sort of when you sell and using that volatility to your advantage. What members should be looking for when they log in and they see their balance potentially drop or they see it go up again? What's the mindset they should have around interpreting that volatility for their own circumstances?
Look, I think in any sort of longer term investment journey, and super is the longest term investment any of us are really ever going to have, volatility is part and parcel of that journey. That over the course of someone's working life, you're going to see any number of substantial market corrections, like, Liberation Day squared. You're going to live through maybe 5 or 6 recessions, maybe
geopolitical sort of
risk,
flashpoints and so forth.
Lots of bad stuff can happen. But if you're prepared to ride out that short-term volatility, the reward for putting up with it is a better long-term result, because ultimately you get rewarded for risk. So if you are prepared to accept that markets do go up and down, you benefit from the eventual recovery in markets.
What if you're retired, you're in your 70s? How are our portfolios constructed to manage that risk and volatility leading into and in retirement?
So the first thing I would say, and this is actually really important thing, is like get some advice. Like talk to a professional that knows what they're doing and understands your personal circumstances.
Yeah, and you can call us if you're a member, but if you've got more complex, comprehensive circumstances, you can talk to that advisor and we can work with them to support.
So we have a carefully designed and thoughtfully designed Lifecycle strategy that we've put together for our members. So for members who don't make a choice, we'll start you in our high growth option. That's the option that delivered the highest returns over 10 years in its survey. And then what will happen is as you approach retirement, we realize the importance of stability in returns because your balance is higher, you're preparing to draw down. And so a bit more stability is important. And what we will do is reduce risk and transition you towards our balanced option.
Okay. And that's then greater exposure to
defensive assets. So more cash, more fixed income, and a slightly less equity exposure.
Excellent. Brian,
And
being the economic fortune teller, What do you see in your looking glass of economic future for us? Are you prepared to make any predictions around rate cuts? Tell us.
Yeah, look, firstly, the Parker family mortgage is 100% variable, so I think it's important to full disclosure. So I do think there is a couple of rate cuts out there. Perhaps one at the August meeting, another one maybe Melbourne Cup Day. But I do think there is scope for the RBA to cut rates further. There's also scope for the Federal Reserve, I think, to take out a little bit of insurance against weaker growth. But I think that short-term economic forecasting is a tough game on a good day, and these are not good days. So when you really are living in a world where US trade policy is almost a week-by-week proposition, trying to make short-term economic forecasts is almost impossible. So look, if we end up with a level of tariff set by the United States that is something business can kind of live with or adapt to, and if the rest of the world basically says, look, we're not going to bother retaliating because why should we inflict higher costs on our own consumers, then the global economy will probably keep growing. It also means that the inflation impact of tariffs globally will be relatively modest. In fact, you might actually see in some countries like Australia, it actually might be good for bringing inflation down further because you might see goods redirected from the US towards other markets that'll be cheaper. So I think what it means is that if all of that happens, the global economy will keep on chugging along. That we'll end up with unspectacular but reasonable growth. That's good news for Australia because at the end of the day, we're a small open economy. We do depend on trade. If there is a major downturn in the Chinese economy as a result of these trade shenanigans, it's highly likely that the Chinese government would stimulate their economy aggressively. That's typically good for us. So I think all in all, as far as we can tell, it's likely to be a reasonable year for global growth coming up and a reasonable year for Australian growth coming up. Better growth, and finally we're seeing some decent growth in real wages. That's good for the consumer. So I think those cost of living pressures.
It's good for the economy too, all that they're spending.
Absolutely. I think still people are going to be a bit cautious out there, but those cost of living pressures we saw in recent years, which are very real, they are starting to ease because real wages are starting to grow again. And so that's a reasonable backdrop for the consumer as well. So lower interest rates, better real wages growth, the fact that the global environment's reasonably friendly, it's not a bad story for Australia.
And these are all good things for investment returns as well.
Absolutely.
The outlook is positive. And if there's one thing I always like to sort of remind people, whenever you pick up you see the newspaper or you watch TV and they say equities are at all-time highs, the S&P, ASX at all-time highs, they're supposed to be at all-time highs. This is the whole, they go up over time. Those are indexes that started at 100.
So in other words, it's not news.
It's not news.
It's not news.
Those indexes started at 100. They're now at 8,000. Like, these are things that grow over time. They're supposed to hit all-time highs every day. It's not news when they hit all-time highs. So don't be scared by the sensationalism. It's good for you when they're at all-time highs because your super is going up.
Growing like a big blue monster. Yes. Okay, so I'm going to finish on your favorite highlight of the year, and then have you been using airports much and creating wealth and prosperity for our members?
I think I wouldn't say it's been a fun year from an economics perspective. As an economist, you've had to revisit all your international trade textbooks to learn about how tariffs work because tariffs have clearly made a major comeback. And just how poorly understood all of this is. And, you know, some of the debate around tariffs and trade has been a bit misleading. So this is not an ideal environment, put it that way. So that's not been fun, but it's certainly been a huge change in mindset and a huge change in how you have to think about the state of the world and how the world evolves. That's exciting, but it's also really, really challenging. As for traveling, yes, I have traveled just a little bit.
Just a little bit.
A little bit, a lot for work. But also I managed to, over the financial year, managed to sky off in Thailand for 2 weeks, which was lovely. So yes, I did use one of the international airports that we own.
Yes.
So I have been contributing to returns in that way.
Excellent. And what about you? Highlight for the year, and have you been generating wealth for airports?
Indeed. I've used 2 of our airports just to get here today, Sydney and Brisbane. Highlight of the year, I mean, I'd almost point to the 30th of June and actually seeing the outcome we've delivered for members. This is money we're managing for 2.4 million Australians. At the moment, there's going to be more and more millions of Australians that we're going to be managing money for as we grow. And it's a huge responsibility, but it's also a privilege. And so when we deliver outcomes like that, I think that's a genuine highlight over the course of the
Yeah,
year.
you should feel proud. My highlight for the year was seeing more of our members get financial advice to help them make really good decisions. And that when those big flashpoints like the Liberation Day, members were calling to before they switched to cash. To me, that's a really big highlight. And it shows, I think, the power of education and financial literacy. And we're doing our little bit on Super Insider to improve that. So listeners and viewers, Andrew and Brian have done an exceptional job explaining the economy and investments today. And we would really love you to share this with your family and friends. We know that so many Australians are invested with Australian Retirement Trust, 2.4 million of them. And we want more Australians to really love and nurture this important financial asset like that big blue monster on the TV ad that looks after you and protects you in retirement. So thank you to our listeners and viewers. Spread the word, Super Insider. It's where it's at. We'll see you next time.